Markets love certainty, or you could look at it the other way. They don't like uncertainty. So they generally de-risk going into an election, especially one that looks like it's going to be as tight as this one looked like it was going to be. So people kind of get out of the pool for a little bit just to sit in safety to see what happens after the dust settles. And then once they know who's been elected and they know what policies to position for, markets sort of re-risk again. So that's part of what's going on. I would say in general, Wall Street is probably more likely to react more positively to a Trump win than a Harris win. So I think we're seeing this too. The market's basically saying, okay, regulation's going to be reduced and Trump's going to be spending more to stimulate the economy than Harris likely would have. And so I think you're getting all that priced in here. There are some other things going on too, like the buyback window just opened, and there are going to be more buybacks done this quarter than I think at any other quarter in history so far of the markets. So you have that massive wave of buyback capital coming back into the market as well. And of course, a lot of people are saying, well, how much more can the sugar high run? It could run longer than people think for a variety of reasons, but certainly as we get closer to the end of the year, you've heard of the Santa Claus rally, that's driven by oftentimes just programmatic things that either have to happen in terms of portfolio rebalancing and things like that. And of course, everybody's window dressing at the end of the year to try to make sure that at the snapshot on December 31st, they're owning the stocks that did really well this year. And that tends to add additional buying pressure. So there's a lot of things going on in the mix there, but it's no huge surprise that the markets are running right now. Companies can, if they have excess cash, they need to decide what to do with it. And they can either invest it into, future operations of the company, or they can return it to shareholders. And people are probably familiar with dividends. Dividends are one common way for companies to return excess cash to shareholders. But another thing they can do is they can buy back their stock. And what that does is reduce the outstanding number of shares of the company. In theory, that should kind of be a neutral event. You're taking some money out of the stock and you're reducing the outstanding float of the company. And therefore, you have a little bit of a smaller pie over a smaller number of shares. And the value per share, in theory, should be what it was before. But that's not really what happens in practice. In practice, for a variety of reasons, the market tends to interpret that as a positive development for the company because future earnings per share go up because there are fewer shares that those earnings are going to be shared amongst. And so anyways, the algorithms and the way the Wall Street machine is set up right now tends to interpret that positively. Now, there are a lot of problems people have with buybacks, and I would put myself in this camp. In theory, if you are running a company, what you choose to do with your excess cash, what you choose to invest it in, should be the absolute best use of that cash, right? If it made more sense to build another factory or whatever, you should be doing that to grow shareholder value. So when your company is buying back its shares, it's essentially saying, we've looked at the universe of everything else in the world that we could do with this money, and we've decided that the number one best investment in this is to buy back our shares. In practice, when they're buying back shares, they're not buying back shares from the general shareholder class. If you and I own shares of Apple and Apple does a share buyback, they're not knocking on our door and saying, hey, can I buy your shares? What they're doing is they're buying those shares from corporate insiders who have big, equity positions, option positions, and they're looking to liquidate those. So it actually it's favoritism to those corporate insiders, many of whom, their incentives are based upon, how the stock performs. And so this is, in some ways, people look at this as stock price manipulation. That, hey, we're buying back our shares. We know that's going to boost the price of the shares. We as insiders have all these incentives that are tied to how the shares perform, so we can drive the direction of the share price in ways that'll trigger our equity value. And we have the company buying. We know we can unload our shares to the company directly. So there's a lot of people that don't like this, and it is hard to a certain extent not to see share buybacks as market manipulation. When you look at the net amount of buying that's been done in shares in the market over the past decade, a tremendous percentage of it comes from stock buybacks, and not for nothing. They used to be illegal, but it's one of those things that got walked back, and it is so beneficial for corporate insiders that nobody wants to get rid of it, obviously. And shareholders are somewhat quiescent in this. I don't think we should be, but we are, because in general, they've been driving share prices up. So if I own shares in Apple and they're doing buybacks and the share price goes up, I feel like, hey, what's wrong with that? I'm making more money on paper. But in reality, it really is, in my opinion, it's a wealth transfer from the existing shareholder base to the small number of corporate insiders who are basically selling their shares back to the company. So I get asked that question all the time. And I think the answer is there's certainly a lot of candidates out there that we could talk about. It could be a collapse in consumer spending, could be trouble in the bond market. It could be a lot of different things. But in most cases, it's the bullet that you don't see that gets you. And if it is sort of a black swan event, but there are studies they've done where you're dropping grains of sand into a pile. And the more grains of sand that you drop onto the pile, the higher the pile gets, the steeper its sides get. And then at some point you start having these slumps, these sort of little mini avalanches, right? And they've done all this, fancy computer modeling, and they can't predict which the grain of sand that's going to cause the collapse of the pile. But what they can predict is each individual, incremental new grain of sand goes on the pile. They can calculate the collapse risk. Like, okay, it's getting higher. Okay, now it's extreme. And usually pretty soon it slumps down, right? And I think that's sort of the way to look at this system we have here, which is, look, there's a bunch of risks out there. We're probably not going to be able to pinpoint with absolute certainty how this thing's going to go down, but we can look at the collection of risks and determine if collapse risk or correction risk is high, medium, or low. I'll tell you right now, in the short term, people are pretty not worried. And by short term, I mean like rest of this year, starting into next year. I don't see many people saying it's all going down tomorrow. To the spirit of your point, though, if I had to pick one thing, if I had to pick the bullet that could take this down, I'd probably go with Michael Howell. He started his career at Salomon Brothers. Very smart guys, very data-driven. He's been kind of Mr. Liquidity. One of the things that I think has been the most directly responsible for this just sort of resurgence of stock prices since the 2022 correction has been net positive liquidity flows. This is just capital continuing to flow into the market that has to get reinvested every month. That flipped positive in October of 2022, which is really right when Michael Howell said, hey, everybody, I'm beginning to feel really bullish about the future. And it's because he tracks global liquidity flows so closely. And he has been bullish ever since. And he said, I still think stock prices are going to go up from here for a while because of this rising net liquidity. But he said two really important things. He said, one is the impulse of that rise is going to be slowing as we get through 2025. Just like when you throw a ball up in the air, right? It starts to slow right before it hits its apex, and then it starts coming down. So we're in that slowing process as we're getting close to the apex. So he said, that's going to likely by itself make 2025 not as a barn burner of a year as 2024 or 2023. But then he said, the thing we really have to watch out for is the wall of corporate debt refinancings that we're finally really beginning to get into the meat of starting in 2025. About a year ago, it was in the headlines, which is, hey, Fed's pursuing a higher for longer interest rate program. The cost of debt is much higher than it was just a couple of years before. And you have all these corporations that have low yield, low cost debt on their balance sheets that's going to come up for maturity. They're going to have to go out and basically refinance that debt at substantially higher rates, like maybe even 2x or more than the current price of the debt on their balance sheet. And everybody was, worried about that, but it kind of just went away. It fell out of the headlines, and to a certain extent, it was kind of out of sight, out of mind. Well, we're now getting to that point in the story where those refinancings are really starting to happen at scale. And yes, the Fed is starting to reduce interest rates, but it's doing, relatively slowly. The difference between a 5.25% federal funds rate and a 4.5% is not tremendously different. Even though the Fed has started cutting its benchmark rate, bond yields on the longer end of the curve have actually gone up since the Fed started this. So debt's actually become more expensive. When you're a company and you're out there borrowing new debt, you're not borrowing at the federal funds rate, you're borrowing at prime plus something. So in many cases, companies that are going out to refinance now are facing an environment where that debt is 2x more expensive, maybe even more. So Michael has said that that's going to start happening with like a rolling thunder in 2025. And that is going to act like a giant sponge, sucking that liquidity out of the market. So that's going to be going on with increasing intensity through 2025. And then at the end of the year, we hit the peak of the liquidity cycle, and it's going to switch to contraction. And then we're going to have several years of contracting net global liquidity. So he's basically said, look, I think the markets will probably be up in 2025, but it's going to be disappointing because everybody's now used to these gangbuster years of returns we've had. And he said, I don't even want to think about 2026. That could be a really ugly year. Well, inflation will impact stock prices. In general, it will hurt them, but it will direct capital to companies that should be able to outgrow inflation, right? And that's why tech and the Magnificent Seven have done so well over the past bunch of years, because people have said, oh, inflation's becoming an issue. I got to put my money in something that's going to outgrow inflation. And that's one of the reasons why they've hoovered up such a massive amount of every new dollar entering into the market. But in general, higher inflation would lead to higher interest rates because the Fed wouldn't be able to cut as much, and it might have to raise rates again to cool off the economy economy to combat that inflation. In theory, that would bring economic growth down and eventually share prices down. Inflation and the future of interest rates / bond yields is like split down the middle right now. This is one of those things that really explain why we have markets where we can have really smart people look at the same data and come up with very different conclusions. You get kind of the Lacey Hunts, the Luke Gromans of the world who look at either the shrinkage we've had in the money supply or the lag effects that they feel, we're still going to experience from the higher for longer regime we've been through, some of the just natural constraints on economic growth that the economy is going to face going forward. And they are very much in the like, oh no, disinflation is going to be in charge for a good while. In fact, we might need to have to worry about deflation. And then you have folks on the other side of the equation who are much more concerned that inflation is sticky, not going to go away. There are some structural things going on in the economy and supply chains geopolitically that are going to keep inflation sticky, and that the bond market is increasingly going to lose faith in the Fed's ability to contain it. And I think it's too early to say this personally, but that's what some people are saying right now when they're pointing to how the long end of bond yields has risen, even though the Fed has started to cut, where they're saying, look, the danger when you're in an era of fiscal dominance for as long as we've been in is that eventually the market begins to lose faith in the central planner's ability to solve things. And as Bill Fleckenstein likes to say, you get a risk of the bond market taking the printing press away from the Fed, where it starts raising yields and impedes the Fed's ability to do the type of rescue efforts that we've all become so accustomed to. This is why nobody believes the CPI, right? And that's what people call it the CP lie, right? Because there's been so many revisions to how the government officially calculates inflation that it's become totally divorced from what people experience in real lives. All the hedonic adjustments and all that type of stuff, right? So yeah, it's maddening. We want deflation in most things. We don't want deflation necessarily in our assets if we are counting on those assets. So we don't want to have deflation that's so strong that consumer spending and corporate profits get so compromised that companies do mass layoffs, right? You might be all on the deflation train until you lose your job, right? And then you're like, well, I'm shafted at this point, right? Now, the point is, there's no way out of this predicament without pain, right? The question is, can we take the smart pain, right? Like, can we really take the medicine we need and emerge, in a much better place after we've paid the price that we need to pay? Are we going to choose bad pain where we end up in a worse situation and, we've maybe done some things in the near term to try to cushion the worst of the blows, but we've traded off, a long-term, even greater wealth transfer or whatever. But that's the process that we've been pursuing for the past, 50, 60 years, is just the can kicking. We don't want to take the immediate pain today. And we as a populace, we don't want to elect politicians who are selling short-term pain to us. We need to get to that point where you can have a credible candidate come up and say, look, I've heard you, this all isn't working for you. We need to take this hard medicine here. You're going to have a couple hard years, but we're going to go through it collectively as a nation. And then here's how we're going to get to a better side. And this is an important point I was meaning to bring up. So you're giving me a good opening for it, which is Trump has just won the election. Trump has a bold set of proposals that he's put out there. Things like, we're going to deport millions of illegal immigrants. We're going to use the threat of tariffs to try to get nations to do more of what we want. He's got some stimulus spending. There's some tax proposals, things like that. And important question I asked this weekend is, and again, this isn't a pro or anti-Trump comment. It's just, let's assume he's successful in those, right? Can he be successful in those without some pretty notable material short-term pain in the economy, right? Like, can you deport millions of people who are currently working? And so you're at least initially losing / displacing those jobs. Those jobs are likely at lower wages, lower benefits, obviously, than you would have to pay a domestic citizen to work. So, that's going to impact corporate profits. Now, you might say, look, it's for the right long-term goal. Totally get it. But my question is, can you do that? Can you win a tariff war without imposing tariffs for a period of time and, forcing consumers to pay more and reducing consumer spending, and therefore that has knock-on effects in the economy? You might win the war in the end and be in a much better position after a couple of years of this. But again, probably likely you're going to take some pretty short-term material pain in the economy. So my next question was, is Wall Street and or Main Street ready for this? Are they prepared for this type of pain? And the answer to that is a completely unanimous no, right? Wall Street is priced for better, whatever better for perfection is. That's what Wall Street's currently priced for. Mainstream's just trying to hang on by its fingernails. And I think is feeling at the majority pretty optimistic now about the economy going forward because they just voted for a candidate that they, basically promised them better economic times. But nobody's really had this adult discussion yet with the country that says, look, If we want to be successful in this stuff, we're going to have to tighten our belts. It's not going to be a painless ride between now and then. And I think that is a big wake-up call coming. And to your earlier question, that could be something that creates a pretty dramatic repricing in the financial markets. If we start having that adult discussion, or even if we don't, but we start feeling that pain because it's the cost of where we want to go, once the market wakes up to that, it's going to say, wait a minute, I got to reprice my economic growth assumptions because they're way too rosy.